to be honest, we're encouraging, and I think our sellers know this, but the banks who are selling on our platform, the properties that they already have in their inventory, it's actually a good time to sell those because you don't have a lot of competition from other inventory, and you still have, demand is weaker, but you still have demand out there. And so before that kind of slow moving train makes its way, and probably we'll see it wouldn't be surprising to see some price declines down the road before that hits. Now is kind of a good window of opportunity to sell.
Welcome to the Accelerated Investor Podcast with Josh Cantwell. If you love entrepreneurship and investing in real estate, then you are in the right place. Josh is the CEO of Freeland Ventures Real Estate Private Equity and has personally invested in well over 500 properties all across the country. He's also made hundreds of private lender loans and owns over 1,000 units of apartments. Josh is an expert at raising private money for deals, and he prides himself on never having had a boss in his entire adult life. Josh and his team also mentor investors and entrepreneurs from all over the world. He doesn't dream about doing deals. He actually does them, and so do his listeners and students. Now sit back, listen, learn, and accelerate your business, your life, and your investing with the Accelerated Investor Podcast.
So hey everybody, what's going on? Welcome back to Accelerated Investor. I am, as always, I'm really excited to be with all of you guys. I'm coming from one of my home offices instead of my work office where I normally do these podcasts and solo casts and guest interviews. Obviously in the middle of this coronavirus pandemic. Hopefully things are starting to subside. So I just want to say thanks. I know all of you are hunkering down. A lot of you are operating from your homes, maybe your home office, sharing a lot more of your house space with your spouses and kids and your loved ones. I'm doing the same. Actually, my wife and my kids are over in our home gym a couple doors over. So hopefully we can get through this amazing podcast and this information without too many interruptions. Maybe you guys have listened to some recent podcasts and seen Dominic on a little bit more often than the past. So that's just real world, right? Running our real estate businesses and our information and data that we put out, this podcast, and doing it in this environment. Today I'm excited because I have a regular recurring guest back with us. His name is Daren Blomquist. He is the Vice President of Market Economics at auction.com. Daren's been a regular contributor of the Accelerated Investor Podcast for years and at our events and our stages and inside of our coaching programs. So I want to welcome Daren back to talk about the state of the market. Daren, what's going on? How are you?
I'm doing well. Thank you. And it's good to be back in different circumstances. I may be interrupted as well. My son just popped his head through the door right before we started, so who knows? Yeah. It could happen again.
Yeah. The spouses and kids are welcome in this environment at any time. Just let them jump on in. That's great. So how are things going for you, Daren? You're obviously working from home. You worked from home a lot before, so you were kind of used to it. But I know you guys are based out of California, so tell us just a little bit about how auction.com is running and what's your environment like for you personally in the pandemic.
Yeah, we've been on stay at home. I think I've lost track of the weeks now, but I think it was about March 15th. So over a month now, which is crazy. And yeah, luckily for me, my job is pretty conducive to doing it anywhere in many ways. But I do miss the environment of going into the office for sure. And we had an incredible effort on the part of our IT team because we have over 900 employees in 3 locations, but they did a great job of allowing pretty much everybody to work remotely. And so that was a Herculean effort, but we're in the throes of it, but definitely looking forward and starting to prepare for getting back to the office. The teams are prepping the offices to start coming back. We're looking forward to that. And, we're in a weird space as a business too, where the foreclosure auctions, and I'll talk a little bit about this in some of the data I'm sharing, but these foreclosure moratoriums affect us very directly.
Right.
And we basically shut down a big portion of our business, at least temporarily. But we know that that's based on past experience. And just looking at the data, we know that that's going to result in a flood of foreclosures down the road.
Right.
Even if it's in a couple of months as those hit. So we're trying to prep for that, and the thing that's really what we're seeing, and I don't want to steal too much of my thunder here, but we're seeing as a business is the online, not surprisingly, the online portion of our business is what is doing very well right now. Buyers can't go to the in-person foreclosure auctions, so they are coming online. And the other part of our business is selling those bank-owned properties through online auctions where you can bid from anywhere. So it's very, very conducive to this environment. And so we're seeing more activity for those, more interest in those online auctions, and more bidding on those online auctions. So that's a big focus for us as well.
Nice. Yeah. And those online auctions can be done right from home. So I've actually bought many properties from auction.com from my home computer, sitting on my couch, drinking a glass of wine next to my fireplace. So that's great.
And I do want to, a shameless plug, and, maybe we can talk about this later, but one of the things we're developing in anticipation for this backlog of foreclosures that's being built up right now that eventually will hit, is technology to allow folks to bid remotely, not just for the online auctions, but for those live courthouse auctions. And actually, you can do that the cool thing about Ohio right now is it passed legislation a couple of years ago, and we helped advise on that allows the traditional courthouse auctions to happen online. So Ohio was actually ahead of the curve in that.
Nice.
So if you're in Ohio buying properties in Ohio, yes, you can do that online, which is really cool, for those in-person, traditionally courthouse foreclosure auctions. Most of the other states, that's not the case. Florida's the one other state where that's the case, but we're working on technology that's going to allow that more across all the. And we were working on this before the pandemic, so it's somewhat serendipitous that we launched it in March. And anyway, I can talk more about that if you want to, but it's an exciting thing. I think that once those foreclosure moratoriums are lifted, will allow investors to access this inventory more conveniently and more safely than in the past.
Got it. So a lot of the data that Daren will share is direct data from the auction.com platform, their website, where they do list and sell foreclosure properties and bank-owned properties and government foreclosures and things like that. So a lot of the data is real time from their buyers and who are clients of theirs, as well as the sellers, who are typically institutions who are also clients of Daren's. And he's got some updated information just over this last 2 full weeks of April. We're recording this on April 24th, and Daren's got some information literally that just rolled out this morning. So we're going to talk a lot about Q1, what we were seeing, because we do these once a quarter. So we talk about the data and what we're seeing about home prices and unit sales and foreclosure information. And then obviously these numbers are all going to be a little bit off or different or skewed because of what's happened in the last 30 days or so. So we'll talk a little bit about retail market trends. We'll talk about some investor insights, and then the distressed market trends as well. So first, we always like to talk about number of unit sales, like home sales by the week, and then also prices. That's usually kind of where we start. And again, if you're watching this or hearing this on a podcast on Stitcher or SoundCloud or iTunes, there is a corresponding presentation, PowerPoint slides that go with this podcast, which is going to be available on YouTube. So definitely look up Strategic Real Estate Coach on YouTube, and you'll find these slides there as well. So Daren, let's just talk a little bit about what we saw 2019 through 2020 regarding home sales. Tell us a little bit more about what you've seen so far.
Yeah, and actually for a lot of this data, we typically do look at this quarterly, but because of the nature of the market that we're in right now, the fast moving pace of things, I started to pull the data by week rather than quarter or even month. And so, for instance, NAR just came out with their March numbers yesterday, which is lagging. The March numbers still show that they're up year over year, although they did come down from the previous month, which is unusual for March. But so I started pulling this data by week directly from the MLS, which is a little bit more real-time view of how things are going. And you do see that real estate, did hold pretty steady through March. You started to see the fall off in the second half of March there. And then the big drop off that you see in sales comes in the first 2 weeks of April. So I think, in March, you were still having sales happening that had been set in motion several weeks before. And so still closed. Those still got through the door, but now you're seeing the sales drop off pretty dramatically. And so when the NAR comes up with their April numbers in about a month from now, you will see, I'm guessing, something along the lines of a 40% decrease in sales in April was what we're seeing in the first 2 weeks compared to last year. So the real estate market is, everybody's, it's slow moving. Wasn't quite as fast to respond, even as unemployment and things like that. But we are seeing the fall off in retail sales.
And remember, this is retail sales and this is home units. So a lot of people, I've over and over and over, I've pounded this to my audience and told them again and again, look, there's two major indicators. There's number of units sold per week, and then there's home prices. And in this environment, what we're all seeing is that supply is down, and so is demand. So they're both decreasing. I don't know if it's at a similar rate, but they're both decreasing simply because people aren't getting out of their homes. People that would have listed their homes on a retail sale are not doing it. They don't want people in and out of their homes showing properties, and buyers are not leaving their homes to go buy properties. So the total number of home units you can see from week 9 was nearly 100,000 sales that week. And now in week 16, which is coming up really close to the end of April here, middle to the end of April, we're down to about 55,000 units. So it's down by 45% total sales units. That doesn't mean home prices just dropped 45%. I want to make sure that that's clear, because some people are like, oh my God.
Well, if you, Josh, actually, you're thinking exactly how I thought. If you go to the next slide, we do look at home prices, which this actually surprised me a little bit. We're actually seeing an acceleration in home price appreciation. So,
wow.
So the blue line is last year home, and this is average home prices. It's not median, it's average, which is a little bit more volatile, but averages. But you still see the trend that, not surprisingly, home prices in 2020 are higher, but they're actually, the gap between 2020 and 2019 is getting bigger in the last couple of weeks. Up 10% in the first week of April, and up 19% in the second week of April.
Wow. So beginning of the year, average home price is in the 375 range. And now it's up like close to 440. It's all of a sudden jumped. Obviously, it's going to change every week, and the number is going to change a lot. But it's just good to see home sale prices going up. I would just be happy to see them staying steady. I mean, I don't know that, again, I think that's going to be fairly volatile over the next couple of weeks, because supply and demand is going to change a lot as certain markets open up and certain buyers are leaving their houses, more homeowners listing their properties for sale, or even rehabbers who are rehabbing properties now are able to finish projects. Contractors are able to get to houses, finish rehabs, and getting them on the market. I anticipate that number is going to fluctuate probably more than we've ever seen over the next 2 or 3 months is my guess. Again, new home listings, this kind of follows along with that data of number of units sold. So tell us about this. Looks like sales listings are way down as well.
Yeah, so this is exactly the point you made a minute ago, that supply is down. And that's, so usually when you would see sales down, that would indicate the demand is weak. And so then you would expect prices to follow. But we're not seeing that. And it's because supply is actually leading here. Supply is down more than demand. So supply is down 52% year over year in terms of new listings.
Wow.
And so that is what's driving this market right now, is people either taking their homes off the market that were already listed, or not listing them in the first place because they, who would want to sell? If you have a choice, you probably don't want to sell in this environment. It's just probably a tough environment to sell in, especially for a real retail seller. And so that's really driving that trend that we saw in the last two slides.
Yeah. So you could make a correlation between supply is way down 52% and prices are up. That would seem to make sense. Again, I'd like to see this play out over the next couple weeks and months to see if that sticks that way. Growth in customers going on their first tour, indicating their first time the property hits the market and going on a tour. Is that what we're looking at here? Yeah,
this is data from Redfin, and really trying to show the demand side of the equation. So if the last slide's, roughly speaking, supply is down 52%. Demand is definitely down based on this measurement, which is basically, saying what's the percentage change in the number of folks going on their first tour of a home through the Redfin platform, at least. Mm-hmm. And it's down. That's down 25%, but so it's not down as much as supply, and it's actually bouncing back up a little bit. If you see there at the beginning of April, at the end of March, it was closer to 40% decrease in that demand. So folks are starting to slowly come back and look at homes, and that's all creating this environment where you have you actually have prices still rising, even though the market is really in a crazy town mode right now.
Yeah. In my newest real estate investing book, The Flip System, you'll learn the proven secrets and strategies that I've used to be a successful real estate investor. You'll also hear the story of my journey from quitting my job to doing over 2,000 units of apartments. The Flip System is now available for a limited time, and you can grab your free copy at getflipsystem.com/podcast. You'll learn the same proven principles and secrets and investing strategies that I used to quit my job and pursue a life of financial freedom. In this book, I'm sharing exactly how I was able to personally close over 750 profitable real estate deals, make over 400 private lender loans, raise over $30 million, and acquire over 2,000 units of cash flowing apartments. Get my newest book now for free at getflipsystem.com/podcast. That's getflipsystem.com/podcast. And I think one of the things that for our audience, maybe that wasn't around in 2008, 9, and 10, you have to remember the 2008, everybody talks about 2008 is when the market imploded. It actually started in the fall of 2006. Many people don't remember this, but that's when a lot of the foreclosure adjustments began to happen, and the 2-year and 5-year ARMs started happening, and defaults started happening. So then Bear Stearns went bankrupt in the spring of 2007. That was the first major big company to go under because of the foreclosure crisis. And then Lehman Brothers was in the fall of 2007. And then AIG and Fannie Mae and Freddie Mac didn't happen until 2008. So my point here is that real estate is a slow moving, as Daren already mentioned, it's a slow moving economic niche, because it's not like stocks where stocks are traded and they can be bought and sold literally in a second through the click of a mouse. Real estate takes time to show properties, write contracts, get to the closing table, get to title and escrow. It takes time. So it tends to lag. And so when the stock market was down 50% in 2008, real estate didn't hit its bottom until almost 3 years. It was took about 3 years. So it was in sometime in 2010, I believe, when real estate was down about 33% and at its bottom before it started to rebound. So I certainly expect with all these 26 million people who have lost their jobs, there's going to be more foreclosures. There's going to be some of that stuff, but you're not going to see it tomorrow. It's going to take 30, 60, 90 days, all these forbearance agreements, maybe 180 days, maybe a year until a lot of that stuff starts to, rear its ugly head, if you will.
Yeah.
So
yeah, that's a really good point. And I think, so we're kind of in this weird environment where and to be honest, we're encouraging, and I think our sellers know this, but the banks who are selling on our platform, the properties that they already have in their inventory, it's actually a good time to sell those because you don't have a lot of competition from other inventory, and you still have, demand is weaker, but you still have demand out there. And so before that kind of slow moving train makes its way, and probably we'll see it wouldn't be surprising to see some price declines down the road before that hits. Now is kind of a good window of opportunity to sell.
Got it. Yeah, now's a good time. I agree. Supply is way down.
It's true for investors too, to a certain extent too. If you have inventory that you can get sold, and of course it's a more difficult environment to sell into, but because so many of people have pulled back including like the iBuyers, you may have this window of opportunity that's to get out there and be the only house on the block that's available for those buyers who are out there.
Got it. Yeah. So I'm just skipping over a slide or two here, just because I see some things that I'm really interested in hearing more about.
Okay.
In this particular survey that you guys that did, kind of this post-pandemic survey, the biggest challenge, this was back, it looks like Q3. What was the biggest investing challenge?
Sorry, that just means question 3.
Oh, question 3. Sorry. Question 3. This was a survey done between April 3rd and April 10th. So this is very recent, about 2 weeks ago. Mm-hmm. What was the biggest question given the recent market volatility? So tell us about that. There's funding, inventory, market prices, contractors, and demand. What did you guys find from this survey?
Well, we saw demand is the biggest challenge. And I actually called in. So this is a survey, just to be clear, of our buyers who are real estate investors buying properties off of our platform. We surveyed about 250, actually is exactly 250 there. You can see and the people who answered this question, 250 folks who responded. And this ranges from small mom and pop type investors to very large institutional investors who are answering this. But the demand was the biggest one. It wasn't far, I wouldn't say far and away. There was a lot of challenges across the board, but that was the one that stuck out. And I did call and talk to a few people and just got some anecdotes. And certainly that is, the issue, meaning, so it runs counter to what I just said. Now is a good window of opportunity to sell. But on the rental side, if you own rental properties, there's a fear, and possibly sometimes it's happening where folks are not paying the rent because either they lost a job or they're taking advantage of the situation, unfortunately. Mm-hmm. And then on the other side, for the home flippers, this one guy I talked to, he had 10 properties. He flips he said 12 to 20 a year. And he happened to have 10 right now that he's trying to sell right in the middle of this. And it was a little tough. I actually talked to him, a couple of weeks ago. Like I said, I do think there may be an opportunity now that things have calmed down a little bit for those properties to move, given that there's less inventory on the market. Mm-hmm. But that's the biggest challenge for across the board, is that more of I guess I call it the disposition side of things rather than the acquisition side of things. Right.
Yep, I agree. So decreased interest in occupied. So occupied versus vacant, right? So this seems to make a lot of sense. Just people not wanting to go into environments or houses where other people could be. So this looks like, again, in the survey, a buyer survey, auction.com buyers, obviously there's a lot more interest or no change in interest in vacant properties, or even an increased interest in vacants versus a lot less interest in occupied homes, right? People want to buy properties that are vacant.
Yeah. And that's been true in the past, that the vacant properties have tend to get more interest because you don't have the eviction process potentially that's happening. But now, given the fact that there's an eviction moratorium, at least through May 17th here, that has exacerbated that opinion, and people are veering away. And at least in the short term from occupied properties, for the most part, there's certain investors who specialize in that and who do seller financing back to the owner occupants. And so they're actually, I talked to one guy, he said, I actually like this because it means less competition for me. If you have that niche where you can go in and you know how to deal with occupied properties, then it's good. But most of the investors that we have are veering away from that because of that eviction moratorium. And in fact, we're actually, just to be a good citizen in this environment, we're asking all of our buyers who buy occupied properties to sign a pledge that they will stick to that eviction moratorium through May 17th.
Yeah, we've got one rental property out of our portfolio of single family homes that was in the middle of an eviction. We can't obviously push that forward. That's on pause. And we've got a handful of foreclosures that we've got going on through our private equity fund on loans that we've made. And all of those foreclosures have been paused. So we're in the middle of it. We see it, actually in real time that those are happening. We did get to see, as far as good news, we have a pretty substantial portfolio of rental properties. We have over 2,600 rentals that are apartment doors. And we actually saw the same collection rate in April that we saw in March.
Very interesting.
Almost identical total dollars collected, total number of units collected in April as in March. And we'll see what happens. People are getting their stimulus money, the PPP SBA loan money. People, hopefully things are going to unthaw. People get back to work here in May. So I do think May 1, this is going to be released right around May, early May. I do think in May, the whole month of May is going to be telling with all the people on unemployment, how many people pay the rent in May, and how many people got stimulus checks and what they use that stimulus money for. I'll be interested to see how that flushes out, not only for all of our students and listeners, but for my own portfolio. Again, buyers seem to be shifting their strategy online. You talked about this in the lead, in the open, that a lot of people are looking to buy properties through online auctions. Just tell us more about some of the survey results that you got and what you're seeing.
Yeah, this was and I think when people think auction.com, they might think all of the properties are sold online. All of the properties you can go in and find out about online, but it's about half of the properties to actually bid on them. You have to go physically to the courthouse steps, and those traditionally actually have been. That's the biggest interest has been in those properties on our platform. But that completely, in a matter of just weeks, that completely flipped. So we see now, and not surprisingly because of the moratoriums, but we see now 61% of folks said their preferred acquisition method is the online auction, whereas only 29% said that was their top acquisition method back in February. Mm-hmm. So that is completely flipped, and people are looking at the online auctions now. And considering those where they may have been just considering the live foreclosure auctions in the past. Obviously our audience is going to skew toward auctions, but we did throw in there the off market and multiple listing. Essentially, multiple listing service stayed the same. Off market gained a little popularity, where it was for 18% of folks, it was their number one acquisition source, going direct to homeowners. It gained a little popularity. And I think the biggest loser here was the in-person foreclosure auctions, and that's really a matter of inventory. The inventory is dried up. I'll show that in a second.
Yeah, and
so
down 70% basically those in-person auctions. So those dollars, if people are active professional investors, they got to go somewhere, right? So a little increase in direct to owner and increase in the online stuff. So page views, obviously this tracks page views at auction.com. Property page views is up big time. That's 65%. That's amazing. And how technology, right? Bidding remotely. I think we're going to see a lot more of this. Again, I think we're learning as a culture a whole new way, all new habits, all new techniques to just not only in real estate, but our entire lives, running our entire lives, the ways that we're going to social distance or shop online, buy groceries and things like that. And so technology is going to be a big part of all of that, including real estate. So tell us about this. How is technology increasing people's ability to buy properties and changing their strategy?
Yeah, and this is I mentioned this earlier, so I don't have to spend too much time on it. But we had been creating this. One of the biggest obstacles to buying at the courthouse steps is you actually have to be at the courthouse steps physically, or at least have somebody there, and that's a limitation for many investors. And to be honest, a lot of times the auction gets canceled at the last minute. So you go, and the property you're interested in, or the properties you're interested in, don't even go for auction. So we had already been building this remote bid technology that allows you to bid basically from your smartphone and track these live auctions in real time. And we actually launched that in March in 4 counties, and it's expanding soon to about over 300, close to 400 counties. But we think that will be a great tool that'll be in place once the foreclosure auctions start up again, to allow people to bid remotely at those traditionally very auctions that require a very high level of person-to-person interaction. And this is just showing how dramatic the fall off has been. The green line is foreclosure, these in-person courthouse foreclosure auctions in 2019. The red line is 2020. You just see it. And this is our data, which we estimate we account for about half of the auctions nationwide that are happening. So it's fallen off, which is, I've made that point several times, but I do want to make the point that we have to look here at the potentially unintended consequence of this is every month, just in our platform alone, which again is about half of the overall auctions nationwide, there's a backlog of about 6,000 properties that are not going to auction every month that regularly would be. And that's in a vacuum absent of the pandemic crisis. And so there is this backlog that's building up, and the longer, if this moratorium gets extended, the problem with that is at some point you're going to have to deal with those properties.
Yeah. You're going to have to increase the supply. And if demand doesn't catch up, where for some reason people just aren't buying as many real estate properties, then prices will come down, right? But if there's supply that starts to hit and there's a bunch of pent up demand and that they kind of equal each other, then property values could stay stabilized. So you've got that 6,000 backlog, and you've got potentially new foreclosures happening, and you potentially have less liquidity in the market. You're also going to have, for some degree, Daren, for retail buyers, you're going to have definitely an issue coming up with getting approved for mortgages, because banks are going to see that people got furloughed. They're going to see they were on unemployment, and the banks were really strict over the last 5 or 6, 7 years of making sure people had 2 years of uninterrupted employment on their employment history in order to get a mortgage. And so the fact that now you're going to have 26 million interruptions in unemployment now, that's going to affect how banks underwrite buyers. And it could be removing a significant portion of those buyers from the marketplace for the next 2 years. If banks stick with that 2-year criteria of having to have 2 years on the job, it could take every single one of those 26 million, take them out of the market. They won't be back in the market for 2 years from now when they can establish 2 years of on-the-job history. I'm interested to see what that looks like, because if you remove all those buyers from the market and then bring all that inventory you just talked about on the market, it could drag prices down to some degree. I don't think it's going to kill it like 2008, 9, 10, but I think there's going to be an adjustment but when you factor all that in.
Yeah, I think you're right. I mean, and my point is I think the lesson from 2008 to me, maybe not everybody thinks this is a lesson, but the idea that you can just kick the can down the road with the foreclosures, there was this push to just, okay, let's not foreclose right away. And, that's well intended, but the problem is that draws out the pain of the recovery, because eventually you have to deal with those properties. And the longer you wait, the bigger there is this pent up supply, to your point. And if it hits at the point that it hits, if you don't have demand to soak that up, then it's going to have a bigger impact on the housing market.
Mm-hmm. Mm-hmm. It looks like the FHA delinquency rates. Again, there's a lot of data on this slide. I mean, the 30-day delinquent, 60-day, 90-day. It all seems to be, obviously, this only runs out through the end of February. So not taking into account a lot of the pandemic stuff yet. This is all pre-COVID. Everything looks to be roughly normal, like within the same range, dating back since 2016. But what's really going to happen when we have you back on in about 3 months, then we're going to have the April, May data, and then that'll tell us what really happened, right? Yeah. I mean, we were already expecting FHA to be a source of weakness in the market in terms of more foreclosures in 2020. But I mean, it wasn't anything crazy. We were just seeing this uptick. If you look at that blue line in foreclosure starts, those were starting to come back up again. And I think that we'll see, unfortunately, FHA is the weakest link, I guess, in this housing market in terms of mortgages, because it is designed to expand access to home ownership. So you have the lower credit borrowers. Those are going to be the folks who are most at risk in this environment as well. Right. Same thing with like delinquencies. Look like those popped up quite a bit. But again, this is Q4. 2019 data kind of matches what we looked at on the previous slide there. So unemployment rate and mortgage performance. This is interesting data, especially because we're really going to get this data coming out in May and June, because this is obviously in arrears, looking backwards. So help us understand what this looks like, because this is a slide that, although we're tracking it now, looks like a slide we'll really want to track in the next 3 months. Yeah, this is analysis put up by Black Knight. I thought it was really good. It's really helpful to kind of see the potential impact. This is really a guess at this point, but they looked at the relationship between unemployment and delinquency rate, basically. Mm-hmm. And back the baseline, if you look on the left side, there is the Great Recession, when we saw a delinquency rate of a total non-current delinquency rate of 14.3%. You had almost 8 million folks who missed their payments as a result of that. It's looking that we're getting, at least as of right now, we're going to be around 20% unemployment when the April numbers come out. And so if that's true and this relationship holds, they're expecting to see under that 20% unemployment scenario there, 7 million folks who miss their mortgages, go delinquent. So that's a huge increase off what we're at right now is 2 million people who are delinquent. So that's kind of talking again about that potential flood of foreclosures we're going to see at some point as a result of all of this. Are you ready to automate and explode your real estate investing? We're searching for extremely motivated individuals who are sick and tired of wasting time and want to finally see real results from their real estate investing business. We're searching for investors looking to get to the next level and become a bigger, better version of themselves while being a more successful real estate investing entrepreneur. Apply for mentoring and coaching at joshcantwellcoaching.com/podcast. That's joshcantwellcoaching.com/podcast. Yeah, and the question then becomes, the banks taking those missed payments, and what are they doing with them in forbearance agreements? Because if they're just expecting that, look, nobody's gotten paid for, let's say, 3 months or 6 months, and they give them a 6-month forbearance, but then on month 7, the bank says, okay, we've given you forbearance for 6 months. Now we need all those payments at one time. Let's use common sense here. Like no average American is going to be able to say, yeah, I've been paying $2,000 a month. I missed my last 6 months of payments, $12,000 plus some other fees. Here's a check for 15 grand. Bring me current. That ain't happening. So what we're going to be interesting to see is, are banks going to be willing to wrap those missed payments, those forbearance payments to the back of a loan, or give people a payment plan? Because we know most Americans already are paycheck to paycheck. So there's no way to assume that they can make up a big chunk of money in month 4 or month 7 after a 3 or a 6 month forbearance. It's not going to happen. So in order to avoid significant foreclosures from COVID-19, the banks are going to have to get creative with what they do. And I've also seen data, Daren, maybe you've seen it, where Fannie Mae and Freddie Mac have now said that they're going to start to buy some of these forbearance mortgages in bulk from banks, because we have to remember what's the secondary and the third, how do the dominoes fall, which is if banks have mortgages on their books that are non-paying, then banks have to set aside more money in reserves to offset those delinquencies and defaults. The more money they have in the reserve, the less liquidity they have, the less loans they can make. So by having Fannie and Freddie buy those forbearance loans off their books, now it creates liquidity for banks to keep lending. So there's all those dominoes that are interconnected. And so it's going to be really interesting to see, because if banks aren't willing to be flexible, this thing is going to get almost as bad as 2008, 9, and 10, because you're going to have tons of people. We're already seeing 20% unemployment. It's going to get very close to that very soon. So, almost by accident, 2008, 9, and 10 could happen again if the banks don't do this right.
Yeah, I think that's really the big question. Is this going to look, I think, to me, there's just using recent history as a guide, this could go one of two ways or somewhere in between, most likely somewhere in between. It could go like 2008, albeit at a much accelerated pace, like things are happening so quickly.
Right.
Or it could look more like, and I'll show this, if you skip down a couple slides, it could look more like, I guess in a best case scenario, like the aftermath of some of the hurricanes that we've seen in the last, and actually if you go up a slide even in the last, back in 2017, and this is part of the Black Knight analysis, is the loans that went into forbearance in the hurricanes. And of course, I'm not saying that what we're experiencing is exactly like the hurricanes, but you do show that the forbearance was a success from the perspective of, basically the bottom line here is the percentage of those forbearance that ended up as going to foreclosure sale was only 1%. So 99% of the people who got forbearance were able to come current. So, 60% got current. Some of them are still delinquent. A lot of, another 20% sold or refinanced. So the vast majority were able to get out of that, recover, get back on their feet.
That's great.
That's kind of the other, I see, this is a spectrum. There's 2008 and there's the hurricanes. I don't think it's going to be as clean as the hurricanes with this forbearance, but they saw that the success that was experienced with that forbearance program and the hurricanes. And so to a certain extent, they're trying to recreate that. I think we'll probably land somewhere in between, but I mean, your point about this, what happens at the end of the forbearance period is a huge piece. And I think the banks at least learned some lessons from those hurricanes about how to then get people into loan mods that don't give them this huge payment shock at the end of the forbearance period.
What's interesting, and I relate this to, owning a bond, owning rental properties, whether it's apartments, multifamily, or even a single family SFR, 1 to 4 unit rental. If you bought it right, you bought it at a wholesale price and you fix it up at a wholesale price and you're renting it out and you have long-term financing on that property. In the short term, it's almost like a bond that has a coupon, let's say a 5% coupon. It's paying you a 5% interest rate, but the price of the bond comes down. you don't really care if you have a 30-year bond or a 10-year bond, because it's going to mature out at the 10-year mark or the 30-year mark. It's going to mature out at the par value at full price, and you've gotten your 5% coupon. You don't care what the volatility is in the meantime. Same with housing. If you bought an apartment or a multifamily house or an SFR and you're getting your rent, which is essentially the coupon from the bond, and you're holding it, and the tenant's paying you rent, or all of your tenants, if it's an apartment, it's paying you rent. Even if that coupon comes down a little bit because there's some more vacancies and there's less payment, but even if the value of your building comes down in the short term, as long as you're holding it and you're not selling it in the middle of this chaos, you're never going to lose. If you're flipping houses and you're dependent on an after repaired value, then there's a possibility that prices could get dragged down and you could lose. So the question becomes, is what type of investor are you? Are you a buy and hold guy? The markets have always proven that simply inflation over time is going to make the property value go up, and you've locked in your loan at, let's say, 3, 4, 5% interest with an amortization schedule. You're going to pay that loan down. So again, it's just more proof that buying and holding properties for the long term is a strategy that's going to win in this environment, because now you're not really necessarily going to care that much about the foreclosures that happen or price decreases. But matter of fact, even if there are more foreclosures, it actually helps you if you're renting houses, because typically when there's more foreclosures, more people move into rental properties, apartments, rentals. Rent rates go up in a depression or in a recession. So it actually can help with that. This is great data to see what they're saying about this. The only problem with this, Daren, as we know, is the whole country is like a hurricane right now, as opposed to just one spot, right?
That's why, I want to be careful about making that comparison. But I do think it's also different than, it's not, you can't say 2008, because this is not some systemic, deeply rooted problem that's ingrained in the whole, structure of the housing market.
Right.
This is a black swan event, classic, I guess, black swan event, where it's just something coming in out of left field that hit a housing market that was very strong. And so I think that gives, it really all hinges on how quickly the health piece of the pandemic, on the one extreme, if you saw the pandemic ease as quickly, which is unlikely, but to see the pandemic go away as quickly as it hit, then you would see this quick rebound. But it's really going to hinge on how quickly that pandemic is I don't know what the word is, solved, I guess, but that will really tell us how elastic the economy is in terms of bouncing back to where it was, and the housing market as well.
So Daren, we've got time for probably one more slide. I saw this one about servicing portfolio volume in forbearance. I thought this was interesting because this is still the early part of April. Now we're into the end of April as of this recording, and the amount of properties going into forbearance is obviously skyrocketing. Very, very fast by all different investor types, Fannie, Freddie, Ginnie, and then others. It's skyrocketing. And that just goes into the conversation we just had about banks and things looking at forbearance as a way to get through the hurricanes, get through natural disasters, offer some forbearance for the next 3 to 6 months. And hopefully the market comes back. And very few of those properties, 1%, ended up in foreclosure. But it is interesting to look at the data and look at the colors and just see how it's the hockey sticking up the amount of properties in forbearance.
Yeah, absolutely. And actually there's some new numbers. So these are numbers from the Mortgage Bankers Association. Black Knight's also tracking this, and they came out with some numbers this morning that show it now at 6.4% of all loans are now in forbearance. These MBA numbers showed 5.95%. So it's continuing to go up. Black Knight says it's 3.4 million loans in terms of a number. And so it's a significant number. And I think there's a lot of how those forbearance loans are dealt with and how quickly they can recover is going to tell us a lot about whether it, how the housing market does in the next couple of years.
Yeah. I feel like in a lot of ways, housing in this environment is hopefully going to be part of the solution, not the problem. Obviously in 08, 09, 10, housing, finance, mortgages were the problem. So it was very hard for real estate to be the solution. In this case, I do think because the market was so good and we don't have really a true, we don't have a liquidity problem. We don't have, massive amounts of foreclosures. Not yet. It's possible if the banks and the major institutions don't work this out the right way over the next 3, 6, 12 months, it's possible to see a major foreclosure crisis again. But it is interesting to see that we have so much recent data from the 08 that I think a lot of bankers and decision makers can make real good decisions based off of a very recent scare just 12 years ago. And I guess, so the lesson for me, talking to my real estate investors is, I think dry powder, cash, liquidity is really, really important right now because you are going to see an uptick in foreclosures. You are going to see an uptick in forbearance. You're already seeing it. You are going to see an uptick in online auctions. But it also doesn't mean that prices are going to just, crater through the floor. It's going to take time. If these forbearances help, it's going to help to stabilize the market. Right now, as Daren said, one of my takeaways is supply is way down 52%. Demand is only down 25%. So if you have properties to take to the market, I think you'll do well to bring them to market because people are looking for those, especially retail buyers are looking for those. I think investors are going to use this as an opportunity, Daren, to use the COVID-19 as an excuse to buy cheap. They're going to go to sellers and say, hey, I see your property's at this price, and it's probably a price that you would have paid 30, 60 days ago easily, and say, no, I want another 10% off. I want another 20% off, just to use the virus as an excuse to get a lower price, even if you would have paid more. So tremendous amount of data here, Daren. Again, tell our audience, all of our listeners and students, where can they get more information from auction.com? I know you guys have a fantastic newsroom. You guys put out a lot of information. If anybody wants to follow up on this and get more data and follow you guys or buy properties on your platform, where should they go?
Well, auction.com is where you can go to get all of that, specifically the newsroom. If you go to auction.com/in the news, that's where I'm putting all our research and analysis. And there's a lot more. I mean, even the things you just said, I could give you some more data to support that. So, and then when we've written recent articles about that. So yeah, we're looking, I think our buyers are on the front lines of this, and they're definitely the ones I've talked to, especially the bigger ones, are abiding by that philosophy that they do want to still buy. They see this as an opportunity to buy. They're not necessarily in a rush to buy, but they see this as an opportunity and are keeping their powder dry. So anyway, we have, I could talk about that a lot more, but go to auction.com, check out the properties, and check out our research and analysis. We'd, hopefully that will be helpful for you.
Fantastic. Daren, I think in this pandemic environment, probably going to make sense to bring you back more than once a quarter. It'd be interesting to see this data roll out month over month. So we'll talk offline about bringing you back more often over the next couple months here, because it's going to be interesting to see what happens in May, June, and July before we get to the end of the Q2. So listen, Daren, thanks a lot. Again, always so much information, a wealth of knowledge, pulling all this together and aggregating this for us. We really appreciate you being on Accelerated Investor.
Yeah, thanks for having me. Good to be here, Josh.
You've been listening to Josh Cantwell and the Accelerated Investor Podcast. Leave a comment on our iTunes channel and let us know what you want to learn next or who you'd like Josh to interview. While you're there, give us a 5-star rating and make sure to subscribe so you can be the first to hear new episodes. Follow Josh Cantwell and his companies, Strategic Real Estate Coach and Freeland Ventures, on all social media platforms now, and stay up to date on new training and investment opportunities. To start your journey toward the lifestyle you've always dreamed of, apply for coaching at joshcantwellcoaching.com.